Good evening, everyone. Today we're looking at financial reporting, and our topic for financial reporting will be IAS 40 investment property. So, this standard is still under this standards under non-current assets. Okay, this standard IAS 40 investment property. Now, let's talk about the objective of the standard. What is the objective of this standard according to the FRS Foundation? IS 40 prescribes the accounting treatment for investment property and related disclosure requirements. So the standard prescribe the treatment for investment property and what are those items to be disclosed as related to this standard. Now let's look at some definition according to the standard. What are these definitions according to the standard? One, let's define investment property. Investment property. So let's define investment property. So according to the standard, what is investment property? So it's a property, land or a building. So it's usually land or building. So when we want to talk about investment property, it's always land or building. So it's always usually land or what? Building. Or parts of a building or both. So it can be both land and building. Held held that is by the owner or by the lessee as the right of use assets. This is a definition in accordance with IFRS 16. To earn rentals or for capital appreciation or both, rather than for use in the production or supply of goods or services or for administrative purpose or sales in the ordinary course of business. Now, when we say investment property, you are saying is any land or building which is owned by an entity or an individual in order to earn rentals. So the purpose of the company holding that property is for rentals for rental purpose or for capital appreciation or for both. That means for both capital appreciation and the rental purpose. So such property, such land, such building is treated in accordance with what IAS 40 investment property. So any other property such as land or building that is being that is being used in production or to supply goods and services, we are saying, or for administrative purpose, we are saying that land or building is PPE. Is what PPE. So it must be treated in line with IAS 16. In line with IAS 16. In line with IAS 16. So any when we are doing our exam that we have a property used for production for supply of goods and services and for administrative purpose, we are saying that property is in line with IAS 16. Why any property, either land or building, which is being held for sales in the ordinary course of business, we're saying that property is what? Inventory. Is what? Inventory. And is must treated in line with IAS 2 inventory. IAS 2 inventory. So what is owner occupied property? Owner occupied property. So it's a property held by the owner for use in production or supply of goods or services or for administrative purpose. So we can also call our PPE, which is any land and building held under PPE or held under IS 16. We can call them what? Owner occupied property. So it's used by the owner of the business. So and they are used for production or for supply of goods and services or for administrative purpose. So we are saying that property should be treated in line with IAS 16. Now, so let's define fair value. What is fair value according to this standard? Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction in an orderly transaction between market participants at the measurement date. So this is the fair value of an asset. Now let's define cost. What is cost according to the standard? Cost is the amount of cash or cash equivalents paid or the fair value of other consideration given to acquire an asset at the time of its what acquisition or construction. So any amount that are being incurred to acquire an asset, we are saying that value, that amount, those equivalent values, it is what the cost of that asset. Now, what is the carrying amount? Carrying amount is the amount at which an asset is recognized in the statement of financial position. So, according to the standard, this is how they define carrying amount. As you all know before now, is that carrying amount is your cost minus what your accumulated depreciation and any impairment losses. So, examples of investment properties. So, what are examples of investment properties? So, one, land held for long-term capital appreciation rather than for short-term sales in the ordinary course of business. So, when a company or an individual purchase a land, when they purchase the land, the aim of purchasing the land is for capital appreciation. That means it's for them to maybe to sell it maybe for like after 10 years or after 20 years. So they acquire the land in order for them for the company to sell it after 20 years or after 10 years. So the reason being is that that land is held for capital appreciation, is not for sales in the ordinary course of the business. So that such land should be treated in line with IAS 40. Now, two, land held for a currently under determined future use. So when you purchase the land now, but you don't know what to use it for, like for right now, you don't know if you want to construct, if you want to build um house on the land, or you want to use the land for agriculture, or you want to use the land for factory to produce a particular item. So once you are not determined, you are not sure of what you use the land for, that land should be treated in line with IAS 40. So that land should be called investment property. A building owned by the reporting entity held under a finance lease and leased out under or operating lease. So any building held by a lessor, and it's being leased out under what operating lease. So we are saying that building should should also be treated in line with IAS 40 investment property. A building that is vacant but is held to be leased out. So when a building is vacant, nobody is staying there, no occupied, no occupant. So we are saying that building, and the major reason for that building is that they are looking for and for occupants to come and a tenant to come and what lease that building. So any building that is being vacant, no, that building should also be treated in line with IES 40. Five, property that is being constructed or developed for future use as an investment property. So when any organization acquire a property or construct a property internally just for future use as investment property, so that property should be treated in line with what IES 40. Now, the following do not meet the definition of investment property. So all these examples are categorically specified in the standard and did not meet the definition of investment property. So one, property intended for sales in the ordinary course of the business. So when you have any property as it's being held for sales in ordinary course of the business, we are saying that property is not in line with IAS 40. So this it should be in line with IAS 2. Property being constructed for third party. So when a business or an organization is constructing a property for third party, so that should be treated in line with what IAS 11, which is a construction contract. But the recent IFRS 15 is supersede IS 11. So all item of IS 11 is inside IFRS 15. Revenue with contract with what customer. So number three, owner occupied property. So it should be treated in line with IAS 16. Any owner occupied property should be treated in line with IAS 16. Now, what is the scope of the standard? One, IS 40 applies the recognition, measurement, and disclosure of investment property. So, how will you recognize an investment property for the initial recognition and measurement and subsequent measurement and disclosure is under the scope of this IAS 40. It applies in the measurement of investment property held by a lessee under a finance lease. So by a lessor and leased out under an operating lease. So it's also treats this kind of lease. Number four, IAS 14 does not deal with matters covered by IAS 17, which is leasing. So IAS 40 does not cover all matters discussed under IAS 17, which is lease. IAS 40 does not apply to biological assets in respect of agricultural activity. So any biological asset in respect to agricultural activity is outside the scope of IAS 40. So we use IAS IAS 41 to treat this. And mineral rights and reserve and similar non-regenerative resources. So any mineral rights and reserve should be treated in line with IFRS 6. IFRS 6. Now let's talk about recognition. What is recognition in IAS 14? Investment property should be recognized as an asset when should be recognized as an asset only when one, it is probable. So it is probable that the future economic benefits that are attributable to the investment property will flow to the entity. So when the future economic benefits attributable to that property will flow to the entity, we say they should recognize it as an investment property. And the cost or the fair value of the investment property can be measured reliably. So this is the two major criteria or for you to recognize an asset, be it IAS 16, be it IAS 2, or be it IAS 40. So these two criteria are almost the same thing in all these standard I just listed. Now let's talk about initial measurements. What is initial measurement according to this standard? So IAS 40 investment property should be measured initially at cost. So it should measure initially at cost, which is the fair value of the consideration given for it. Transaction costs are included in the initial measurement. So any transaction cost should be included in the initial measurement. Meaning of cost. Now this cost also follows the principle of IS 16. So all initial measurement, they follow the principle of IS 16. So we should be able to understand the initial measurement of IS 16. So you can go back to our class on IS 16 to read and revise the initial measurement and look at the series of illustration given to us according to that standard. We say initial measure meaning of cost. One, the cost of purchased investment property comprises its purchase price, and any directly attributable expenditure. Directly attributable expenditure include, for example, a professional fee for legal services and property transfer taxes. So you should understand that a professional fees is part of initial recognition, initial measurement. So as at the point whereby you want to initially recognize the asset, I mean at the point whereby you do not know the cost of that asset, you are still accumulating the cost of that asset. So you are saying the cost of professional fee should be part. Two, if a property uses the fair value model and is self-constructing and an investment property, then you should value that property at fair value during construction. So mostly the standard favored the fair value model. Now the standard says that when an entity or an organization is constructing the standard favor the fair value model by saying if an entity is constructing investment property internally for self construction or for self use, for self use as an investment property, we are saying the company should use fair value model if during construction phase, if they can ascertain the fair value of the assets at each point. IAS 40 allows that if fair value cannot be measured reliably during construction, then the property can be valued at cost until construction is completed. Now, the seller said that if the company cannot ascertain the fair value during construction, then they should wait after construction at the end of in which the asset is being constructed. Then they should ascertain the fair value of that property. Number four, when construction is complete, the property should be valued at its what? Fair value, at its fair value. Now, subsequent expenditure. So, subsequent expenditure, this is always in line with the IAS 16. So, subsequent expenditure can be capital expenditure or recurrent or revenue expenditure, which is a recurrent expenditure, revenue expenditure or capital expenditure. So we say one, day-to-day cost of running the investment property are recognized as an expenses as incurred. So this is example of what revenue expenditure. Revenue expenditure. Two, if a part of an investment property requires replacement during the useful life of the property, the replacement part is capitalized when the cost is incurred, as long as the recognition criteria are met. As long as the recognition criteria are met, any value remaining in respect of the replacement part will be derecognized as the new cost is capitalized. Will be recognized as the new cost is capitalized. So you are saying any capital replacement or capital expenditure under any investment property, that part that is being replaced or is being incurred should be capitalized to the cost of the investment property, to the cost of investment property. So measurement subsequent to initial recognition. Now measurement subsequent to initial recognition. So an entity should choose either the fair value model or the cost model. So after the initial recognition, which is mostly initial recognition should be at cost, but the standard favor the fair value. But after the initial cost or initial recognition of that asset, the entity can also value the fair value. Can choose either using the cost model or the fair value model. So let's talk about the fair value model. Application of the the model. IAS 40 prescribes when to use fair value, which is IFRS 13 fair value measurement. Define fair value and how it should be measured. So this is how IFRS 13 define fair value. Is defined as the price that would that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. At the measurement date. After initial recognition, an entity that chooses the fair value model entity that chooses the fair value model should measure all of its investment property at the fair value except in exceptional circumstances. So once you choose the fair value model, you should measure all your investment property using the fair value model. So a gain or loss arises from a change in the fair value of investment property should be included in profit or loss for the period in which it arises. So when there is change in the fair value, maybe the fair value of 2014 increase, that is higher than the fair value of 2013. So the change should be included in our profit or loss under other income. The fair value should reflect the actual market, and the circumstances at the end of the reporting period, not as of either a past or a future date. So the fair value should not reflect the past transaction or future date. Now, fair value measurement consideration. The fair value of missing property should reflect, for example, rental income from current lease and other assumptions that market participants will use to price it under current market condition. So, according to fair value is stated in line with IFRS 13 fair value measurement. So, how to calculate how to value our fair value, we should always look at that standard IFRS 13. That is why I can introduce IFRS 13 to foundation to our skills level. So that standard is one of the standard we should look very very well. Now, what are the exceptional circumstances? We say there is a reputable presumption that an entity will be able to measure the fair value of an investment property reliably on a continued basis. However, in exceptional cases, there is clear evidence when an entity first acquires an investment property, or when an existing property first becomes investment property, that the entity would not be able to measure its fair value reliably on a continued basis. In such cases, the entity measures that investment property using the cost model in IAS 16 until the disposal of the investment property. The residual value of investment property should be assumed to be what? Zero. So in exceptional cases where it's not possible to ascertain the fair value of the investment property, the entity should use the cost model, the cost model. The entity measure all its other investment property at fair value. The term evaluation. The term evaluation should not be used when discussing the fair value model under IAS 40. Evaluation is an IAS 16 or IAS 38 accounting policy, and fair value is a method of valuing investment property under IAS 40. So we should understand that the evaluation, when we say the evaluation is um which is the valued amount is different from the fair value, and in most cases, asset that we use a valued amount for is asset that is being held as owner occupied property in line with IAS 16. So that means any any a valued amount or any fair value that is being higher than the cost or the previous fair value in line with IAS 16, the increase is called revaluation surplus. It's called revaluation surplus. And it must be credited under other comprehensive income, and which will now warrant a evaluation reserve in our statement of financial position. But as far as IAS 40 talk about fair value, now the increase in the cost and the fair value is called the fair value gain. It's called the fair value gain. It's called the fair value gain. It's called the fair value gain. And this fair value gain should be credited under our profit or loss statements under other income. Under what? Other income. There is much difference between other income and other comprehensive income. So we should be able to know that the difference. Now our cost model. Our cost model. After initial recognition, an entity that chooses the cost model should measure all of its investment property using the cost model in IAS 16. So our cost model is always the cost less accumulated depreciation and any accumulated impairments losses. An entity that chooses the cost model should disclose the fair value of its investment property. Change in method. Yes, this standard allows change in method. Change in model. Say IAS 40 allows an entity to change the usage of of any property from IAS 16, which is owner occupied property, to investment property. So the company can change them to investment property, or it can change from investment property to IAS 16, owner occupied property, or from investment property to IAS 2, which is inventory. A change from one model to the other model should be made only if the change will result in a more appropriate presentation. IS 40 states that this is highly unlikely to be the case of change from the fair value model to the cost model. Okay, so the standard also allows us to change from one model to another model, which is from cost model to fair value model. But the standard does not permit changing from fair value model to cost model. Now, as I explained before, I said we can change the usage of a property, which is meant by transfer. So you can transfer a property from a investment property to IAS 16, unoccupied property. So transfer to or from investment property should only be made when there is a change in use. When there is a change in use, a change in use. For example, for example, for example, for example, one, the owner occupation commence. So the investment property will be treated under IAS 16 as an owner occupied property. When there is a transfer from investment property carried at fair value to owner occupied property or inventory, the property costs for subsequent accounting under IAS 16 or IAS 2 should be its fair value at the date of change of use. So whereby an entity transfer its usage or how it will use a property, which it's classified as investment property, they now transfer it to owner occupied property, which is IAS 16. The cost as at the date of transfer or at the date of change in usage is the fair value as at the date of change in usage, who will now be deemed to be the new cost of the investment property. So the same thing happened to IAS 2 inventory. Conversely, an owner occupied property may become an investment property and need to be carried at fair value. An entity should apply IAS 16 up to the date of change of use. So when an entity is using a particular item for owner occupied property, they now want to change, to investment property. From that date of usage to the date of change, they must use the principle of what? IAS 16. So any value, any increase in the fair value should be treated as what? As revaluation surplus, not fair value gain. It should treat any difference at that date between the carrying amount of the property under IAS 16 and the fair value as a revaluation under IAS 16. Under IAS 16. Any evaluation surplus up to the date of transfer will be recognized in other comprehensive income and presented in equity. So, as at the date in which the asset is being used, so that means the asset was used as owner occupied property up to the date of transfer or change. So the company will keep on any surplus as at that point should be treated at evaluation surplus. So let's look at our first illustration, illustration one. Illustration one. Say Norwich Limited owns a building which it has been using as a head office. That means any building used by a head office. An head office is for what? Administrative purpose. Remember now that building should be treated in line with what? IAS 16, which is owner occupied property PPE. In order to reduce costs, on 30th of June 2019, it moved its head office functions to one of its production centers and is now letting out its head office. Now, they've transferred the usage. They transferred the usage. So, now the companies transfers the usage of their head office, which is an administrative purpose. So, they want to lease the asset now, the building out. Now it's now being transferred. This is now is not it has been changed to what? An investment property. Which is on 30th of June 2019. Company policy is to use the fair value model for investment property. So the policy is to use fair value model for investment property. The building had an original cost. The building the building had an original cost on 1st of January 2010. So the building the initial cost of that building as 1st of January 2010 of two is of what? 250,000 naira, and was being depreciated over 50 years. At 31st of December 2013, its fair value was judged to be 350,000 naira. You are required. How will this appear in the financial statements at 31st of December 2019? So when we say how will it appear in the financial statement, we're talking about how will it affect our profit or loss statement and our statement of financial position. Now, so this is also how will it affect is me how will it affect our profit or loss statement and our statement of financial position. Now, the company has a particular head office, which is used for owner occupied property, IAS 16. You now change it to investment property, and the cost now how will it affect our statement of profit or loss and the other comprehensive income and our statement of financial position. So let's look at it. Firstly, we must first of all account for the building from the day of acquisition, which is 2010, to the day of transfer. So we want to know the value as at that day of transfer. So the value as at that day of what transfer, which is the current amount as at that day of transfer. So our workings is that calculation of the annual depreciation. Firstly, all with the depreciation to get our carrying amount as at the date of transfer. I will say our carrying amount is the cost minus our accumulated depreciation. So our depreciation is 250,000, which is the cost of the asset in 2010 divided by 50 years. It's 5,000 per year. Now from 2010 to 2019, from 2010 to 2019, December 2019 is 10 years. It's what 10 years. So you can calculate it with your hand in most cases because do exam you are permitted to calculate with your hand. But if you use mathematics, you define that is 9 years, which is not nine, because this first of 2010 will be the first year, 10, then 2019 will be what, then 10 years. Now, but the day of transfer of usage was 30th of June 2019, which is not December 2019. So it will be 9 years and what 6 months. 9 years and 6 months. That is what when it is being used as owner, as it is being used as owner occupied property, as owner occupied property. So the accumulated depreciation is what 5,000 times 9, which is 45,000. The current year, which is 2019's own, which is the half year, which is from January to 30th of June 2019, is 6 months. So 6 months is half a year. So the half a year multiplied by the 5,000 naira, it will be 2,500 as our current year depreciation. So our current depreciation will affect our current year 2019. So it will have current year. So when we add the current year depreciation to our accumulated depreciation, we have so our total depreciation, which is both the accumulated depreciation and our current depreciation, will be what 47,500. Now, using this, we will now look for the current amount as at the date of transfer. So what the current amount at the date of transfer, and the current amount at the date of transfer, which should be the fair value of the investment property as at the date of what transfer. Now the current amount is the cost minus accumulated depreciation, which is 250,000 minus 47,500. So our current amount is 202,000 naira. Now we are told that the fair value as at the date of transfer is we are told that okay, the fair value as at the end of December 2019, so at the end of the year, so at the end of the year, it was 350,000. So here we have to calculate our revaluation surplus, because this is not a fair value gain or loss, because the asset was previously used as owner occupied property. That is why is the difference between the revalued amount, which is the fair value of 350,000, and our carrying amount is 147,500. This is our what revaluation surplus. It's our revaluation surplus, and that surplus should be treated under other comprehensive income. So you look at our profit or loss statement. How will it affect is our depreciation for the current year, which is 2019. Only item of 2019, because our profit or loss is for a particular year, which is 2019. Which is 2019. Now, the depreciation is 2,500 naira. That means we have to debit our profit or loss and credit our account depreciation. So that is the reason why we have a depreciation under our profit or loss statement. Why our parent surplus should be one hundred and 47,500. So it should be under our evaluation surplus. Under our evaluation surplus. So by doing that, you find out that the current value, which is the fair value of the asset, is 350,000. That's the figure that will affect our statement of profit, statement of financial position, which is what 350,000 naira. So that which is our revalued amount, So our next class will start from disposal of investment property. And we'll look at other illustration. So see you our next class. Good night.